This is Mastering Your Wealth with David Gagnon, the podcast.
Does spending decline over the course of retirement? Well, with all this inflation, you'd probably say no way. But listen to what financial advisor Dana Aspect recently told Finstream TV.
Right now, where everybody's talking about the price increases of gas and groceries, we are routinely saying, we have built-in inflation raises for you. Would you like to increase the monthly paycheck that you receive? There's room to do so. And even though we test and we model and we show them that they could increase it and it's not going to increase the risk of running out of money, overwhelmingly, we are still hearing people say, no, I'm comfortable on what I'm receiving. So they're absorbing those costs or making trade-offs, but nobody is expressing that they're feeling that pinch.
That's interesting to me. You think inflation is up, taxes is up, we're spending money a lot faster than we have been. So the idea that people are like, no big deal. I'm comfortable, David. Don't worry about it. It's interesting to me. So are people coming in saying, I need more income? What have you been seeing out there?
This is one of the most misunderstood areas of retirement planning. Spending doesn't follow a straight downward line. It follows behavioral curves. What we typically see is early in retirement, we have high discretionary spending. People are anxious to retire, want to do things that they've been planning on doing when they get into retirement. Typically spend more. They might travel more. Halfway or midway through their retirement, we see people start to stabilize their spending. They're slowing down maybe, and they're seeing that, we better cut back sooner or later, or else maybe it may not last long enough. And then later in years, what happens is there might be rising healthcare out-of-pocket costs that forces people into a high spending environment. And I see this a lot. And it's scary when that happens, when you have just a modest nest egg size, because, we have a family member that's been in skilled care nursing homes for a while now, spending $200,000 a year in Connecticut. And in one more year, they will be out of money. And that started with a pretty high seven-figure nest egg about 10 years ago.
Oh, my goodness.
And both spouses needed that type of care for a period of time. This is something we try to help people plan for earlier in life when they're healthy and implement healthcare strategies without buying traditional long-term care insurance, which is quite expensive these days. And so it's something that is a backup strategy to your overall planning. Now, when you layer inflation on top of everything, when people are going through retirement at whatever stage they might be in, it might feel comfortable at a time, but then it becomes unstable later in retirement when inflation has been creeping a little bit at a time, eroding that nest egg and requiring more spending to maintain that lifestyle. So we don't rely on assumptions. We stress test every plan. And that's the key. We want to know today, what is your threshold for making it all work throughout your life expectancy for higher inflation, possibly longer life expectancy, maybe paying more in taxes, or something that might happen with a loss of a spouse, because that changes your spending, your income plan, your income sources. So we just don't rely on assumptions. We just want to make sure we stress test a plan to know where our guardrails are before you start to derail. And one of the things that we always want to be protecting a portfolio in an income phase is early market downturn if somebody's relying on a market-sensitive plan to derive an income from. And that's what we refer to as sequence of returns risk. If that market goes down in the early years of your retirement and you're positioned in the market, that could prematurely deplete your nest egg. So we show people how to mitigate that exposure. If we have sustained inflation higher than historical averages, we want to make sure the plan can sustain that higher spending need. Some people don't think they're going to live long term and don't plan that accordingly. And then if they don't, and they're in their mid-80s and they're really healthy and they didn't think they'd still be around at that age, that could be a problem, and unexpected healthcare costs. So the trigger to recheck the paycheck is when you look at withdrawal rates becoming unsustainable or market exposure too high relative to income needs, tax inefficiencies that start compounding. Tax planning is critical, and we always want to make sure you're tax efficient in your income distribution years. So I had a couple a little while back that had literally 1.3 million, and they felt they were good. They did their own math. In their assumptions, they were assuming 6 to 7% returns every year, no disruption in the market. Everything was a steady return, linear every year, and stable inflation. So what we did, we stress tested their plan with a 20% market decline in the first 3 years, a 4% inflation because they were using something much lower. And the result that we could show them was that their portfolio was depleted in the early 80s. And they both felt they were going to live beyond 90. So that kind of took them back a little bit. So what we did was we redesigned and segmented their portfolio into an income component and a growth component. And we introduced some guaranteed income to cover their essentials. We adjusted withdrawal sequencing for tax efficiency because they were able to draw from some buckets that were tax deferred and tax free. And now their plan holds up across multiple stress scenarios because of the restructuring we did, and we actually implemented a real strategic plan based on what their objectives were. So that's the difference between a projection and a plan. And we always talk about having a plan in your numbers, and that's the key. And so, we encourage people to get an assessment as to whether what they're currently doing by looking into the future is sustainable or not, because that's why we do the forecast analysis without changing anything. And we do an investment portfolio analysis to see if your investments are truly aligned with your long-term needs for income, growth, tax efficiency. Now, when you know your numbers and you have a plan, your decisions are very easy.
Yeah, it makes sense. You got to plan with your numbers. This forecast analysis that you're talking about here for our listeners, a great opportunity to see where you are today, where do you want to be, and then most importantly, that's where David comes in. He's going to start drawing that route to get you where you need to be in the best way possible, the most tax-efficient way possible, and giving you the best income plan that suits you and your needs. Again, if you'd like to come in and do this complimentary forecast analysis, no cost, no obligation, that phone number, 203-872-0009. 203-872-0009. That website, masteringyourwealthradio.com. David, have you heard of these terms? I mean, the first one I think a lot of folks have, FOMO, right? The fear of missing out. This can kind of apply, when the market's going up and you don't want to be the only one that didn't jump. So you're jumping right in with everybody else. YOLO, you only live once. I remember when that was popular a couple years ago, and this kind of pertains to spend it like you're going to die tomorrow. Just start throwing it out the window, right? Whatever you want, when you want. And then you have JOMO, the joy of missing out. You don't necessarily care, and you're happy not jumping in with the crowd. That's what that means. So with each one of these conditions, which one of them would be the best for a retiree to adopt?
Well, without question, for retirees, the healthiest mindset is JOMO, the joy of missing out. Because retirement isn't about chasing opportunity. It's about protecting your income, maintaining stability for many years. So let's break these down in a real world context. So FOMO, the fear of missing out, this leads retirees to chase performance, jumping into hot markets, trends, or sectors at the wrong time. That's extremely dangerous when you're no longer earning a paycheck. Now, if we look at YOLO, you only live once, this can show up as overspending early in retirement, front-loading lifestyle decisions without understanding long-term consequences. So that could be risky. JOMO, joy of missing out, this is discipline. It's saying, I don't need to chase every opportunity. I just need my plan to work. And that's obviously the safest of the three. JOMO aligns perfectly with long-term income stability and sustainability, risk management, it aligns well there, and emotional control during volatility. Had a client a while back, and the client during a strong market run felt like they were falling behind. So they wanted to shift more heavily into high growth tech stocks. And that increased their risk significantly. So we walked them through their income needs, their timeline, what a downturn would do to their withdrawal strategy. And then they chose to stay disciplined because within months, the market corrected, and had they made that move, it would have significantly impacted the retirement plan. And so the way we could show them how to build stability in their plan with a good investment and income distribution strategy gave them added peace of mind going through retirement. They didn't feel like they had to hit the home run and find the best stocks to really try to keep pace or ahead of inflation. So instead, their income remained stable, their portfolio stayed aligned with their personal goals and objectives, and they avoided unnecessary stress. So in retirement, success is not about catching every opportunity. It's about avoiding the mistakes that can't be undone. because you have one chance to get it right in retirement, right? So when you're in your working years, yeah, you can make some pretty poor investment decisions along the way, but you can rely on your weekly or monthly paycheck to pay the bills and let your portfolio recover from some bad mistakes. So retirement is very critical to make sure you're making some good, sound financial decisions, because there's no do-over.
For more details or to sit down with David for your complimentary financial GPS, visit masteringyourwealthradio.com.
Investment advisory services offered through Brookstone Wealth Advisors, LLC, BWA, a registered investment advisor and an affiliate of Brookstone Capital Management, LLC. BWA and First Financial Planners are independent of each other. Insurance products and services are not offered through BWA, but are offered and sold through individually licensed and appointed agents.
Information provided is not intended as tax or legal advice and should not be relied on as such. You are encouraged to seek tax or legal advice from an independent professional.
Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.
David Gagnon and First Financial Planners are not affiliated with nor endorsed by the Social Security Administration or any other government agency.
Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interests of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure, the ADV 2A Item 4, for additional information.